Welcome to the 2016 fall meeting of the Credit Suisse Research Institute, which discusses the future of monetary policy. The Research Institute is our bank's in-house think tank and focuses on research of global trends that shape the world of today and impact the world of tomorrow.
We discussed for almost 2 days monetary policy, its impact, what we see down the road, all in an attempt to get a better view as to how we should read the road forward and to be in a better position to advise our clients on the trends we see, to position them well with their investment ideas.
Since the crisis of 2008, central banks have moved to center stage. I think there's a consensus that had it not been for their very strong actions, the financial crisis would have been much worse. There's a lot of criticism about the manner in which they went about it.
In my view, since the 2008 financial crisis, monetary policy had become unconventional, but there was a good reason for that. The growth was too low, inflation was too low, and we needed them to avoid double-dip recession and deflation.
Every part of the private sector and the government sector has been reducing spending and has been deleveraging. So the only offset to that actually has been central bank activity with the expansion of central bank balance sheets through the quantitative easing programs that we have seen. So if we had not had quantitative easing, arguably the world would have gone into a significant downward spiral in terms of growth.
Central banks can't conjure prosperity and growth and productivity improvements out of thin air. Monetary policy buys time, it brings spending forward, but the heavy lifting in the real economy has to be done by governments and by businesses.
They need parliaments, they need the private sector, they need the social partners to step in. Otherwise, they will be totally overburdened. The monetary policy will remain incredibly accommodating, and we will only pave the way for the next difficulties, if not the next big crisis.